Today, Bitcoin trades at the $94,000 level to kick off the week. The Trump Organization announces the world's first tokenized hotel development project. And Nicolai Sondergaard, research analyst at Nansen, breaks down what's behind the latest crypto price action. Welcome to CNBC's Crypto World. I'm Mackenzie Sigalos. Major cryptocurrencies are getting some reprieve to kick off the week. Digital assets were plagued by a pullback last week, culminating in a broad sell-off in risk assets on Friday. Now, as of noon Eastern, Bitcoin was pretty much unchanged at that $94,000 level compared to 24 hours before. Meanwhile, Ether and XRP both rose more than 2% this morning. Now, on Friday, Bitcoin fell below $95,000, wiping out nearly all of this year's gains. And the cryptocurrency's retreat below 100K is raising questions about whether the sell-off is just another shakeout or the start of something deeper. The cryptocurrency, of course, notched several milestones this year, including a new all-time high above $126,000 early last month. Since then, though, it's slumped around 25% into bear market territory. Industry experts tell CNBC this could be a two-stage downturn, an initial macro-driven sell-off, followed by forced liquidations. Longer-term investors, on the other hand, argue that the foundations of the digital asset story remain firmly in place. John D'Agostino, Coinbase head of institutional strategy, joined CNBC Squawk Box this morning to discuss crypto's recent sell-off and whether investors should buy into digital assets right now.
I try to step back and ask myself, what has fundamentally changed since, let's say, late September, when everyone was incredibly bullish? And the answer for me is nothing. Structurally, we're where we were, if not better. We have the Czech National Bank announcing a central bank Bitcoin purchase, the first Eurozone country to do that. You've got Citibank and JP Morgan announcing stablecoins that they're using to facilitate customer transactions. You've got Harvard Endowment's announcement. You have successful ETF launches. So it's a challenging environment currently, but in my house, we like apples. I don't like apples less when they're on sale. So if you like this asset, you should like it at a discount.
Okay, let's talk about the top stories. The Trump family is diving even deeper into the Web3 space. The Trump Organization today announcing the debut of a Maldives resort in partnership with UK-based developer Dar Global. At the same time, they announced the development of that resort would be tokenized. Now, the announcement mentions that rather than tokenizing the completed asset, this would give investors access to what the team describes as a high-growth real estate investment from the start. Eric Trump, who serves as the executive VP of the Trump Organization, said the development would set a new benchmark for innovation in real estate investment through tokenization. The Trump family, including President Trump, have taken on various crypto ventures in recent years, which in turn has caused critics to raise alarm bells over potential conflicts of interest. Donald Trump Jr. told CNBC just last month that those concerns were, quote, complete nonsense. The criticism came to the forefront again last month when President Trump pardoned Binance founder Changpeng Zhao. Critics pointed to a $2 billion deal that Binance was involved in that utilized a Trump family-tied stablecoin. Next, Bitcoin could be used to warm homes this winter. A new report out from CNBC on Sunday explored the push among entrepreneurs to heat American homes using Bitcoin mining. Now, it is well known that mining needs a lot of energy and generates a lot of heat, about as much needed to heat all of Finland, in fact, according to digital assets brokerage K33. So businesses, they're starting to think of ways to unlock this potential rather than letting it go to waste. Jill Ford, CEO of sustainable Bitcoin mining company Bitford Digital, told CNBC that these machines could run quietly in people's attics and then use the heat-intensive process to warm the entire home. In another example, in February of this year, New York Times Wirecutter reviewed a space heater that doubles as a Bitcoin mining rig. However, skeptics believe that with Bitcoin mining having become as concentrated as it has, solo miners stand very little chance of hitting a block. Now, for more on that story, check out the article on CNBC.com. All right, back to markets for our main story. This afternoon, I spoke with Nicolai Sondergaard, research analyst at Nansen, about what's driving the current crypto price action and whether we can expect reprieve for the rest of the year. So let's start with your reaction to the pressure on the crypto market right now. What are you watching, and what should investors be paying attention to?
Yeah, sure. I think there's a few different things that you could look at. I think many are looking at ETF flows. I think it's important to also look at what treasury companies are buying. And I also think it's important to see if the open interest is going up. So do we see increased interest around leverage once again? Or are people still a little bit scared, after the October 10th liquidation event?
So when it comes to Bitcoin in particular, are we in for a pullback through the end of the year? We were hearing some calls for new all-time highs by end of 2025, but where do you think we stand now?
I mean, if we look at the options data specifically for Bitcoin, it looks like in the short term, at the very least, we're about to be range bound. So it could be a little bit up, a little bit down from where we currently are. I think it's at 92,000 USD. But from there, there seems to be quite a lot of interest around the options for the 26th of December, pulling up above the 100K line again. So going purely based on that, we might be seeing 100K before the end of the year.
So major cryptocurrencies aren't facing the same level of volatility that they have in the past, even with these recent drops that we've seen. What's providing that support right now, and what kind of investor is staying long?
Yeah, sure. I think the most obvious example is strategy. So with Sailor behind it, in the past week, I believe they bought another 1.8K BTC. So these large institutions, these treasury companies are definitely providing this cushion that we didn't have before when it was purely a retail investment play.
So you mentioned that there was strong options interest in late December. Now, driving that interest, isn't there usually profit taking in the final days of the year?
Oh, there definitely is. I guess for tax season, I guess it's usually end of November, leading up until the mid of December, where we see most of the profit taking, at least for tax purposes. But at least looking at the options now, I think institutions and high net worth individuals are looking to protect themselves in the short term, but largely still expecting some sort of upside.
Are there any bright spots or underappreciated parts of the market that investors should be watching?
First of all, I think the market is maturing. We are seeing regulation across several countries, and I think that's only a benefit for the industry as a whole. And we're also, despite seeing outflows from Ethena and also Bitcoin, we're seeing inflows to Solana. So it seems like there is some appetite for risk, despite where the market is currently.
Now, as we look ahead to 2026, do you expect the selling pressure to fade into the new year, or what are you looking out for?
I think it will largely depend on people and macro. So when I say people, I mean, is everyone on the same page with regards to what matters for the price to go up? In a lot of cases, herd mentality plays a big role, especially in crypto. So that's something I'm looking to see in combination with easing liquid markets.
You mentioned that there is still a risk appetite with funds moving into Solana, but I feel like it's the altcoins and some of the meme trades that have really taken it on the chin the last 6 months. So talk to me about that side of the trade.
Yeah, that's a great point. I was recently going over a chart that looked at active addresses on Solana in the beginning of the year versus now. And if I remember correctly, the number of active addresses was above 1 million early in the year, and it's now hanging around 100,000. What this seems to show is that retail largely have exited the scene, at least right now, which sort of makes sense with how often we feel about money. If prices go down, we're kind of scared. So from that perspective, it makes sense that there's not as much activity at this point.
Something that I've been trying to square is the splintering of the crypto investor. So you've got the traditional spot market, and then you saw more institutional players come in through the spot Bitcoin ETFs in the last almost 2 years. But then this summer, we saw the rise of the digital asset treasury trade. And so, that was a pretty smart investment over the course of the few months that they were really doing quite well. We've seen a lot of those DATs come down in the last 2 months and retail get burned in the process. And I guess my question here is, one, for the first part of it, is that hurting the spot market price because we're seeing money go into these DATs that don't necessarily match on their balance sheet a one-for-one investment when they see more inflows? And then two, retail investors, are they having a form of PTSD, not wanting to get as involved in the crypto market because they got burned in the DAT trade?
Yeah, if we tackle retail first, I think in each cycle that happens across crypto, there's always people who do get hurt. Sometimes it's more and sometimes it's less. So that means there's always people going out. But at the same time, when the market sort of rolls back on, there's new people coming back in, or sometimes the same people like to come back in. So that's where that's at. Now, with regards to whether or not DATs are hurting the price of spot Bitcoin, for example, I wouldn't necessarily say so. I think we can think of it as another leverage trade. So another way of getting exposure. And if retail would prefer to buy a stock or an ETF, I think that's a good option for them.
So then why are we seeing names like Coinbase, Bullish, Robinhood, these digital asset exchanges have been suffering these double-digit percentage losses? Is that just in sympathy with crypto prices coming down, or is it because they're seeing less trading volume as retail investors turn to alternatives such as some of these DATs that we were just talking about?
I mean, I haven't looked at the trading volume on Sexes recently, but if it is coming down, that would indeed hurt the the price in the end. That means less revenue for these companies. At the same time, they do hold quite a lot of these assets, so one could say that it's quite easily correlated due to the fact that their success sort of hangs on these assets performing well.
Where are we with respect to either the Ether proxy trades like a BitMine immersion or the spot Ether ETFs themselves being able to stake the Ether that they hold?
I don't remember where we last were from a regulatory standpoint, but I know we are moving towards it. And I think that's going to be beneficial as many of these companies are willing to stake these ETH, which makes sense as it's another source of revenue for them. But other than that, I can't say much.
Okay, that's all for Crypto World today, but we'll be back again tomorrow, and we'll see you then.